Suppose that the production of widgets has an external cost. Maybe it's air pollution or water pollution created when we make widgets. Well, this quantity of 5,500 that is determined by supply and demand does not take into consideration the impact that the production of widgets has on those who are not consumers or producers. That is, it doesn't take into consideration the cost of that air pollution or water pollution. So how can we get people to internalize that cost and prevent the quantity of widgets being produced from being too much? Because the quantity of 5,500 is more than is socially optimal. Well, one option is to have an excise tax. What we do is we take the supply curve, and instead of having the supply curve, we have what's called the marginal social cost curve. The marginal social cost curve represents the cost of production, that is what's in the supply curve, but also the external cost. So let's suppose that the external cost is $10 per widget produced. Then the marginal social cost curve is simply the supply curve shifted up by those $10. So at a quantity of 5,500, the marginal social cost curve is at a price of $60. And if we were lower here on the supply curve, we would simply shift it up vertically by $10, or higher here on the supply curve, we shift it up by $10. So we have our marginal social cost curve. If we can get people to internalize that external cost, then we see that the quantity produced in the market will decrease to 5,000. So we can fix the problem of overproduction. To get people to internalize that external cost, we need an excise tax. And the amount of the excise tax is equal to that external cost, that $10. Well, we can see on this graph who ends up paying the tax. Because the price in the market goes from $50 now to $56, and the tax paid on each unit is $10. So let's create a little bit of color here. So we go $10 down from the current price, and we go over times the number of units produced. This is the tax revenue. This is how much the government receives. It is equal to the $10 tax times the number of goods sold when the tax is present, which in this case is 5,000 units. So our tax revenue then is $50,000. Everything above the $50 but below the demand curve used to be consumer surplus, and everything above the supply curve but below $50 was producer surplus. Part of the consumer surplus is used to pay the tax, and part of the producer surplus is used to pay the tax. We can see that the price of the good did not go up by the full amount of the tax. That's because the tax is being shared between the consumers and the producers.